Compensation structure. We all know a sound compensation structure must be based on job evaluation in order to establish fairer differentials in payment depending upon differences in job content. In this lesson, we will discuss the concept of internal parity, external competitiveness, identify how pay systems are designed, the concept of fixed pay, variable pay, and ESOP. After going through this presentation, you should be able to discuss internal parity and external competitiveness, identify the pay system design, discuss fixed and variable pay, explain employee stock option plan, describe the factors affecting compensation plan. The internal parity method undertakes the job position in the organizational hierarchy. The process aims at balancing the compensation provided to a job profile in comparison to the compensation provided to its senior and junior level in the hierarchy. The fairness is ensured using job ranking, job classification, level of management, level of status, and factor comparison. External competitiveness refers to how an employer positions its pay to what competitors are paying. How much we wish to pay accounts in comparison to what other employers would pay them. Employers have several policy options. Increasingly, organizations claim their pay systems are market-driven. The policy on employee contributions refers to the relative emphasis placed on performance. Should one programmer be paid differently from another if one has better performance and/or greater seniority? Policy regarding administration of the pay system is the last building block in our model. While it is possible to design a system that incorporates internal consistency, external competitiveness, and employee contributions, the system will not achieve its objectives unless it is managed properly. The simplest way to design a competitive pay structure would be to follow the steps given below. First, to establish by market rate surveys and studies of existing structures and differentials of the most senior and most junior jobs to be covered by the structure. Draw up salary grade structure between the upper and lower limits as established in step 1. According to policies for differentials, the width of salary grades and the size of overlap between grades. Slot the jobs into the grade structure in accordance with the results of both the job evaluations and the market rate surveys. It is here that judgment is required. While some decisions on grades will be obvious, others will be more difficult. If in doubt, re-evaluate the borderline cases to help make the final marginal decision. One advantage of an overlapping structure is that such decisions are less critical. Obtain market rate data bearing in mind that there is likely to be a range of market rates rather than a precise figure. Conduct a job evaluation exercise preferably by means of a simple ranking scheme, although this could be refined by using paired comparisons. Fixed pay is non-discretionary compensation that does not regularly vary according to performance or results achieved. It is compensation method in which only a fixed salary but no commission is paid. The amount received by an employee is a function of time worked and not of performance as reflected in production volume. This method is used where 1. The firm is aiming at long-term presence in the market instead of short-term production volume. 2. The firm is aiming at thorough familiarization of a new market or geographic area. 3. The performance of each employee is difficult to measure. In fixed pay system, compensation depends on the amount of time or effort spent on an activity and independent of output consideration. Input also not always easy to measure and time at work as a proxy in order to assess workers' effort are the problem of fixed pay system. Wage per hour, monthly salaries, and annual salaries are the example of fixed pay system. In variable pay system, compensation depends on measure of what comes out, and the amount of time spent on work does not affect workers' compensation. Output, not always easy to measure, is a problem of variable pay system. Agricultural workers, piece rates, P tray, a salesperson on straight commission, compensation of top executives by stocks or stock options are the example of variable pay. Pay for performance is also known as variable performance linked pay or contingent pay. Variable performance in the pay is a financially measurable reward paid to an individual based on his overall performance. Most employees prefer that performance rewards increase their base pay rather than be given as a one-time lump sum payment. The merit incentive pay scheme provides another method of recognizing and rewarding differential performance. This method could particularly be suitable for office staff. Skill-based pay links pay to the level of schemes used in the job and sometimes the acquisition and application of additional skills by the persons carrying out the job. Incentive or bonus schemes relate to the pay or part of the pay received by the employee to the number of items they produce or processes, the time they take to do a certain amount of work, and or some other aspects of their performance. In individual or straight piecework, a uniform price is paid per unit of production. Operators are therefore rewarded according to the number of pieces they produce or process. So pay is directly proportionate to results. In a work measure scheme, the job or its component task is timed and the incentive payment is related to performance above the standard time allowed for the job. Stock options are opportunities to buy stock at a set price immediately or sometime in future for a stated period. Stock options plan is one of the two forms of variable pay compensation package, other being profit sharing bonus. ESOP is a type of tax-qualified employee benefit plan in which most or all of the assets are invested in the employer's stock. A stock option plan grants employees the right to buy company stock at a specified price during a specified period, once the option has been vested. An employee stock purchase plan (ESPP) is a little similar to a stock option plan. It gives employees the chance to buy stock, usually through payroll deductions over a 27-month offering period. ESOP is becoming popular in view of the following factors. The shift from industrial to information revolution. Knowledge workers expect say and stake in the organization in which they work. Next is public policy in many countries favor giving employees a share in equity and profits. In the wake of disinvestments and privatization of public enterprises, employees are offered shares with view to ease their opposition. Stock options can be introduced not only by public traded organizations but also by privately held firms. In the past, companies offered stock options to only a handful of top-ranking key managers. In several public enterprises, employees were offered shares on special terms at the time of disinvestments and/or public offering. Initially, trade unions in the bank and several public enterprises resisted the idea of workers owning shares because of ideological aversion to workers' capitalism. The amount of compensation received by an employee should reflect the effort put in by the employee, the degree of difficulty experienced while expending his energies, the competitive rates offered by others in the industry, and the demand-supply position within the country, etc. Jobs vary greatly in their difficulty, complexity, and challenge. Some need high levels of skills and knowledge, while others can be handled by almost anyone. Projects determine the paying capacity of a firm. High profit levels enable companies to pay higher wages. Inflation reduces the purchasing power of employees. To overcome this, unions and workers prefer to link wages to the cost of living index. When the index rises due to rising prices, wages follow suit. Prevailing wage rates in competing firms within an industry are taken into account while fixing wages. Highly unionized sectors generally have higher wages because well-organized unions can exert presence on management and obtain all sorts of benefits and concession to workers. Now let us check if we have understood the various concepts discussed in this lesson clearly. How an employer positions its pay vis-a-vis his competitor's pay is referred to as external competitiveness. Right or wrong? Right. Variable pay is also referred to as straight method. Right or wrong? Wrong. Fixed pay is non-discretionary compensation that does not regularly vary according to performance or results achieved. Right or wrong? Right. Before we end, let us briefly revise what we have studied so far. A sound compensation structure must be based on job evaluation in order to establish fairer differentials in payment depending upon differences in job contents. Besides the basic factors provided by job evaluation, job description, and prevailing rate, there are many other factors that are taken into consideration for determining wage structures. The internal parity method undertakes the job position in the organizational hierarchy. The process aims at balancing the compensation provided to a job profile in comparison to the compensation provided to its senior and junior level in the hierarchy. Fixed pay is non-discretionary compensation that does not regularly vary according to performance or results achieved. It is the compensation method in which only a fixed salary but no commission is paid. Variable pay is also known as pay for performance or contingent pay. Variable performance in the pay is a financially measurable reward paid to an individual based on his overall performance. This measure includes the cumulative performance of the individual, his strategic business unit, and that of the organization. The amount of compensation received by an employee should reflect the effort put in by the employee, the degree of difficulty experienced while expending his energies, the competitive rates offered by others in the industry, and the demand-supply position within the country, etc. Though stock plans are a relatively recent entry into the Indian corporate world, stock plans have made an impressive impact on the industry and are destined to grow. These plans can have many objectives and can be structured as simple one-off schemes or as complex ongoing ones.